What do you call it when the world's biggest economy is bleeding $4 million every single minute, and its largest creditor walks out the door, slamming it shut behind them? Imagine the horror. The United States enters the second quarter of 2025 expecting a mountain of cash, $850 billion in reserves. But when the curtain rises, the Treasury is nearly half empty. The money simply isn't there. And at that very moment, China detonates a financial bomb, dumping $1.7 trillion in U.S. Treasury bonds. The dollar ignites in flames. Washington scrambles to borrow a staggering $514 billion just to keep the economy from spiraling into chaos. Mortgage rates skyrocket. Inflation explodes out of control. Allies retreat. And the U.S. debt, once the unshakable fortress of global finance, starts crumbling into dust. This was no glitch. No accidental stumble. It was a shot fired in the global economic war. A brutal, unmistakable signal that the rules of power are being torn apart. Every 60 seconds, America piles on more than $4 million in new debt. But after China's ruthless sell-off of Treasury holdings, that debt became a crushing weight, one that threatens to collapse the system. Beijing sold off $1.7 trillion in bonds, triggering a borrowing frenzy that forced the Treasury to scramble for $514 billion. A jaw-dropping 317% surge from just 2 months earlier. The trigger? Washington's iron fist slammed down on Chinese firms, blocking major banks from supporting a critical Chinese EV battery company's IPO. This weaponized finance, Beijing responded with an equally brutal counterstrike. The consequences hit like a tsunami. The dollar plummeted 9%, bond yields soared, and gold shot up as terrified investors fled U.S. assets like rats abandoning a sinking ship. Now America is forced to bankroll its geopolitical ambitions with borrowed money it doesn't have, while the world watches, wondering if Washington's strategy is on the brink of collapse. When giants like JP Morgan and Bank of America were ordered to withdraw from the $5.3 billion IPO of China's dominant EV battery maker, the fallout was more than financial. Reuters warned this could cost the U.S. billions in lost future access to China's vast financial markets, a crippling blow. This wasn't just a business deal. The company was linked to China's military-industrial complex, flagged by the Department of Defense as a strategic threat. The banks backed down, threatened with devastating regulatory retaliation. But China's response wasn't just talk. It was a financial scorched earth, liquidating massive U.S. debt holdings and shaking global markets to their core. The timing was brutal and deliberate. China slashed Treasury holdings to $759 billion, the lowest level since 2016, while hoarding gold reserves month after month. This is a calculated, unrelenting move to break free from dollar dominance amid rising geopolitical tensions. IMF data reveals a seismic shift. The dollar's share of global reserves fell from 64.7% in 2016 to just 57.4% in late 2024. This is not a trend. It's a revolution. Beijing is shedding U.S. debt like dead weight, signaling a ruthless pursuit of financial independence. The Treasury expected $850 billion in cash going into Q2 2025, but found less than half, a staggering $46 billion gap. With the federal debt ceiling back in play, Washington was forced to borrow far more than anyone anticipated. Officials claim the cash collapse added $53 billion to borrowing needs. But why were assumptions so outdated as liquidity evaporated? Wall Street braced for $255 billion in borrowing, but the actual figure doubled that overnight, exposing catastrophic miscalculations. If the Treasury can't get the basics right, what else is unraveling behind the scenes? Some analysts cling to hope, pointing to tariff hikes as a potential budget patch. But early signs are bleak. Apple reported a $900 million tariff hit in Q2, pushing talks of raising iPhone prices. A perfect storm gathers on the horizon. The clock is ticking. The questions are stark and unforgiving. How long can America borrow billions every minute? How long before this financial unraveling sparks a global crisis, reshaping power and toppling empires? The stakes have never been higher. The game has changed, and the world holds its breath for what comes next. Inflation isn't just ticking up, it's exploding. Consumer prices surged to 3.4%, a brutal leap from 2.2% last quarter. But this is no fleeting hiccup. It's a full-blown structural crisis tightening its grip on America's economy. Soaring import costs are crushing corporate profits. Margins vanish. Tax revenues stall. Meanwhile, the burden of sky-high interest payments from exploding bond yields is strangling the government's budget. If tariffs were supposed to buy stability, the numbers reveal a much darker truth. They're pulling the noose tighter around the nation's fiscal neck. Behind every Treasury auction, there's a family feeling the squeeze, paying more for less. With China exiting U.S. debt markets, yields on 10-year Treasury bonds have surged past 4.6%. and they're forecast to hit a terrifying 6% by May 2025. Mortgage rates? They've blasted to a 15-year high of 7.8%. Auto loans? Now north of 9.1%. Student loans? A crushing 6.6%. What does that mean? Affordability is crumbling. Families, especially middle-income ones, are getting crushed under this relentless wave. The Consumer Price Index paints a grim picture, rising 3.4% in Q1, fueled by soaring food and energy prices. Bloomberg reports household purchasing power has plummeted 5.1% year-over-year, a staggering hit to millions. And the dollar? It's tanked 9% since Beijing dumped U.S. bonds, pushing imported essentials further out of reach. But here's the real kicker. The fallout from Washington's financial moves isn't landing on Wall Street. It's crashing down on Main Street. As China retreats, U.S. allies are pulling back too. In the first quarter of 2025, foreign investors abandoned U.S. assets to the tune of $317 billion, the steepest exodus since 2016. Saudi Arabia, once a top 10 Treasury holder, chopped its holdings by 22%. Congress, meanwhile, has pushed BlackRock and Vanguard to unload $812 billion tied to 220 Chinese companies, injecting a new level of political risk into global capital flows. The fallout? Asian IPOs on U.S. exchanges have cratered, with only 28% of Asia-based firms choosing U.S. listings in 2025, down sharply from 75% just 3 years ago. Tokyo and Frankfurt are stealing the spotlight with rising bond demand and listings. The U.S. isn't just losing investor confidence, it's losing its crown as the globe's financial hub. This silent retreat by allies isn't dramatic or loud, but it's far deadlier because it's stealthy and relentless. Washington doubles down on debt to fund grand policy ambitions, while Beijing is quietly building escape routes. In 2026, China will roll out a national credit rating system to bypass Moody's, S&P, and Fitch, rating agencies that have unfairly saddled Chinese enterprises with up to 120 basis points in extra borrowing costs despite better fundamentals. China is also revamping its cross-border payment systems to cut out SWIFT, the US-dominated network vulnerable to American sanctions. BRICS Pay processed an eye-watering $56.4 billion in Q1 2025, nearly half transacted in local currencies. These aren't fringe moves, they are seismic shifts reshaping global financial architecture, designed to shield Beijing from Western pressure. As more nations join China's orbit, the looming question becomes stark. Will the US dollar remain the world's reserve currency? Or will it become a regional relic, propped up only by fading legacy? The Treasury's latest borrowing plan is ambitious. $514 billion in Q2, $554 billion projected in Q3, aiming to rebuild a cash balance of $850 billion. But the reality? As of mid-May, the cash balance is only $563 billion, 33% below target. JP Morgan warns that banking on a smooth debt ceiling deal is dangerously optimistic. The market's patience is thinning. Fiscal promises are colliding with harsh cash realities. Rating agencies are sounding alarms, signaling that if Congress fails to act, a full-scale recalibration of U.S. sovereign credit ratings is imminent. With BRICS pushing alternatives, China shedding dollar liabilities, and traditional allies hedging bets, the U.S. stands at a crossroads. Reform now. Reshape fiscal and geopolitical strategy. Or watch America's financial empire crumble slowly. Not with a bang, but a grinding, irreversible erosion. These aren't distant worries. They're happening right now. Mortgage rates climbing. Investor confidence fracturing. The global economic center of gravity shifting under our feet. Beijing isn't waiting. BRICS isn't hesitating. Washington? Still clinging to the illusion that legacy power can hold everything together. But the debt clock doesn't stop for politics. Markets don't trade on nostalgia. So here's the question no one's asking loud enough. What if the next Treasury auction fails? What if allies stop calling U.S. bonds safe and start calling them exposed? What happens then? Drop your thoughts in the comments. Because what's coming next, from wild interest rate shocks to a recalibration of reserve currencies, will force every nation, every company, and every household to choose a side. If you want to stay ahead of that breaking point, subscribe now, hit the bell, and join us as we track the unraveling, or the rebirth, of American economic power. Thanks for watching. If this shook you, like, subscribe, and check out the next video queued up now.